the online stuff, so I'm gonna loop them in right now. Just a second. So we run like a mix of online, offline, though I think I might just limit the online to only people that have been here for a while. So I'm just gonna give it, turn it on real quick, because it's already 10:05. Start your meeting. Because I know people tend to kind of just come in like minutes after. Hey, good morning, Steve. Let me know if you can hear me. I'm setting up a little bit. Got the speaker. Oh.
Okay.
Oh, that's messed up. Good morning. Good morning. So good news, Steve. I got the pipeline or the deal with Dr. Yang, and we're gonna host awesome meetups or mixer events with a lot of tech investors and entrepreneurs, hopefully. Let me just share my screen. We'll start in a bit, guys. Oh, forgot to plug this out. Yep, I know. Thanks, man. So let me give you guys a rundown. So you guys are sort of new. We're going to be hosting a tech mixer. So this is the gentleman that I've been talking to. He said absolute. So this is the recent message I had with him, Steve, if you're looking. Wait, let me see if I'm sharing my screen. Screen is shared. Yeah. So yeah, this is the email right here. Absolutely wonderful. I am checking with my partners this weekend and next week to see if they're okay. Then we're looking for a mixer to be held in about 2 weeks. So in 2 weeks' time, we'll try to host like these really big events. When we discussed in the meetup or the meeting with him, he came here, Dr. Yang. He said about at minimum 40 people, and then it could go up to 100. He said, but he said maybe like 80 is like a cap. I don't think we could do 100 in here. That's too much. But it's just basically. The format is really the investors are going to be there, hopefully, with like co-founders, the entrepreneur basically. And each co-founder that comes in, they're going to have 1 minute to pitch their idea. Like, hey, this is my, investment, or this is my tech idea. If you guys are interested, follow me after, and then we'll break out into like a networking session. So just chit chat, eat a little snack, and have some fun. Yeah, let me show you who the guy is. I know Steve already saw it, but for the people who just came in. So he runs this organization. He's an older gentleman. He's been doing it for a while, 6 years if I recall. This is him right here, Dr. Yang. And then I guess this is his partner. But his meetup, so he has like 5+ meetups. This is one of his meetups right here. So they have this one has 12,000. I've seen another with 14,000, I think. But they get a lot of people to kind of come out. Hey, Shati. Hey, what do you think, man? New place.
Pretty good.
I got some coffee for you guys in the back, so feel free. Yeah. Well, we haven't started yet. It's just some new people here and talking about this.
I was trying to find out like
the entry.
Yeah.
Yeah, I know it's a little tricky. Probably.
But then I came upstairs and I heard your voice, so.
Okay, good. But is the front door open?
Yeah.
Okay, good.
Everything is open.
Okay, good. I left it open because if it closes, then no one could get in. But anyways, let's sort of begin here. So, let me see if anyone's online. Okay, there's still one person trying to connect. But anyway, so after a while, guys, 77 meetups is pretty tough. And I decided that for me to continue to do this, because I want to do it every week, just because I was talking to my buddy this morning and I said, hey, what do you do on weekends, man? And he was like, I'm still sleeping, because I called him at like 7. For me personally, I don't have much to do, and I guess this is what I enjoy doing. After this, you'll find me at a cafe, reading a finance book or something, or watching Real Vision. So I don't have much to do, and I know that the different people that come into here, the mini sessions we have, the way I've been like teaching and talking about investing is like I've been going up and down, like super advanced, and then if they don't know anything, I bring it low and then bring it back to advanced, up and down. But I haven't really had a session where I really cater to basic people who kind of want to, just get started. So I want to make this more basic. So the series is going to be basic, intermediate, basic, and then advanced. But I'm going to try and make it interesting for like the advanced people that do come in. Because we'll still talk about deals, investing, and all that. But anyways, welcome to the number 78 session. So let me know, any thoughts, curiosity, anything you want to hear. Feel free. But today we're just really going to talk about the stock market. All right, Liz just jumped on. Hey, welcome, Liz. So what I like to do typically is I like to go around the world and see what's going on. And this is basically called inter-market analysis. In the beginning, I know people mostly just look at one stock, and then it's kind of like, I wouldn't say narrow-minded, but that's just kind of what you're used to, right? But over time, there's the stock market. You have to understand that there's many markets out there. There's the stock market, the bond market, the futures market, the real estate market, the private equity market, which has like venture capital, or maybe even hedge funds. And they all have their own financial profiles that you can analyze, right? So with that being said, that's basically intermarket analysis. When we look at different markets between bonds and stocks, what's going on in bonds or in the volatility market, the derivatives market basically, and how will it affect the stock market? That's something that you'll learn as you kind of become more advanced. Like no beginner could really like understand that yet. And so I find it kind of funny because when I teach in this club, I forget what it's like to be a beginner. And so when I sat down this week to kind of like think of what to talk about for a beginner session, it was kind of hard because I'm like, I don't know what to say. But that's intermarket analysis. So for example, when you pull up, we personally like to go to FinViz. We also like to go to Guru Focus. This is a little bit more advanced, but it focuses on fundamental analysis, deeper fundamental analysis. If you don't know what fundamental analysis is, it's basically the analysis of the financials. Every company has financials, and we look at the financials and base our investments off that. So there's different types of investors and profiles. If you come in looking to trade, well, I like to trade too. I'm more known as a swing trader, meaning I hold my positions anywhere from 2 days to like almost a year, just because I find that useful. But then, what type of trader is one aspect, but what segment do you invest in? Are you a growth, value investor, etc.? So that's another thing we're going to kind of talk about as the introduction today for you guys. So let's begin with the intermarket analysis, or the look around the world and see what's going on. To give you guys a little sneak peek at the, oh shoot, I didn't even have the document out. What we're going to talk about is, let me pull it up, number 78. I'm going to get you guys like a little excited, like why should we invest in stocks? Like why the need to learn about stocks, right? It basically comes down to like, what do you know about your money? Like, do you know your money is not safe in the bank? So we're going to talk a little bit about fractional reserve banking, central banking, and stuff like that. Just a little basic, just a little dabble into that to kind of get you excited about, okay, I need to take my life seriously and start learning about investing. Because if you don't, your sovereign will devalue your hard-earned money that you put in effort, which is your economic resource, your time to go earn. So that's like the whole inflation, deflation stuff. But that's something that we'll hope to escalate into talking about. So quick analysis around the world. What I like to do is, we could look at one stock, but that doesn't really give you an overview of what's going on in the world. So what I like to do is, we like to look at the stock indices, stock index. So one stock index, the main one that we look at, and it's pretty much the main one that like almost every money manager looks at, in my opinion. Though, teaching thus far, I've come to realize there's other major indicators as well, right? We're just looking at one market. So when we look at SPY, SPY is an ETF, an exchange traded fund. It tracks the S&P 500, which is the top 500 biggest companies in the US, the most economically impactful. So whatever happens on this chart, 4 out of 5 stocks follow this chart. So if you're a day trader, day traders have this stock, the intraday of this stock, pulled up on the side. in like their, along with like their level 2 and all that. Level 2 is just like another, it's a day trading tool. We'll talk a little bit about that. But anyways, this is something that you need to start gauging and understand. And as we kind of progress in this club, we start looking at the derivative of this, something that derives its value from the S&P 500, which is options. And then within the options is volatility, and that's kind of how the name of this club came to be. A little intro, my mentor, he's a volatility hedge fund manager. He introduced me to volatility, and it kind of just like, shaped my life from here. I call this club Volatility Club. So that's another story too. But anyways, going back to the S&P 500, right? We really like to look at this and see what's going on. As of this week, well, late in the week, things start performing really well. As you can see, S&P 500 tested the 270, right, in our 100-day moving average. So I know right now it looks kind of scary. Maybe I could break it down a little bit simple for you guys, right? I mean, let me remove all drawings. Clear drawing set. Yeah, so I mean, in most simple forms, right? If you just took out everything, it would look like this. And you're probably wondering, like, why do we have all the lines and stuff? It's really just like a trick to kind of help us understand where we stand, right? Like let me ask like some of the people online right now, like Steve or Liz, if you guys are there, or Pishang, like looking at the chart naked like this, like, if you guys have any comments, like how do you feel? It's like, whoa, it looks so different. We never look at it like this. It's kind of how I feel when I look at it. It's only when we add like context to it where we basically understand. So what I like to do is I like to add a few moving averages, which I just kind of took off. So we could add the most simple one. These are like the standard that you should know when you're starting off. So I'm just going to put 2 on here to keep it very basic. But one is going to be the 20-day moving average that we're going to leave in there. And then over here is the 50-day moving average. And really just having those two is just a powerful combination already to kind of look at charts, right? So I put those 2 on, and now we have a reference. We could reference it somehow, saying like, oh, the price patterns are above this, above the 20-day, which is our blue, meaning that this is expressing some type of momentum buying action, right? Versus if we didn't have it, we wouldn't know. So that's why we have all the lines. A little basic intro to that. So looking at S&P 500 this week, we have the 200-day moving average, right, which is our pink line. The 100-day is this one, the 50 and the 20. We've been watching this for a long time because since February, we had a major pullback. It's just volatility that got introduced to the market. I was actually listening to a money manager talk yesterday on Real Vision, and they were saying that several reasons. It's some believe that it's like the 40 basis points increase in interest rates, because that's like economic tightening of the system, right? Others kind of believe like it's the whole Trump and stuff, but at the end of the day, it seems like the majority thinks it's interest rates in the dollar. That's like the most concerning thing about the markets right now. Hey, Sylvia.
Hey.
Haven't seen you in like a year, is it? So I'm guessing you want to join the basic series?
Yeah.
Okay. Oh, I'm gonna make it interesting even for the advanced people. And the type of approach I want you guys to kind of think of it is, even though you think you're advanced at this point or intermediate, repetition is still good. Like I'm teaching, I'm repeating. That's what helps me get better. You gotta refine your I guess your basics. But anyways, going back to the around the world look. Yeah.
So what is the moving average, and why is there a difference between the 200 and 150?
Okay, so the moving average is basically, it takes so let's say for example the 50-day moving average, 50 days of data. So every day at the close of the bell, it'll mark a data. And then you go 50 data points back and you get a smooth average line. So a lot of money managers, the standard that I'm seeing everyone looking at, regardless of like if you're a trader or if you're a money manager, everyone looks at the 20, the 50, the 100, and the 200 on the daily chart, right? Why do I emphasize daily chart? Because look, how do we all communicate across something that's like, that has no structure, right? So we add structure to it because most people, they come in, they look at the one, this is 1 minute right here. So this is 1 minute intraday. This is just one day. This time from the open of like last Friday to the close. This is just one day. Even day traders, they add context to the one day by saying like, oh, what happened in the first 15 minutes? Did it break out or whatever? Yeah, that's coffee. You could, yeah, I bought the coffee.
Sure.
Yeah. If you're not sure, you could always ask. Just kidding. Yeah, I got it like about an hour ago. So that's intraday, but for the purpose of like you guys starting out, we're gonna focus on the daily time frame. So each candle right here, they call it, is one day. And so the moving average that we have set up right here, the 50 and the 100, is based off of 50 days, or 20 days for this one, and 50 days for this one. That's really just the difference. But we use that as context to take a position or not take a position, or assess our risk, right? Because like, how would you know to buy right here when you didn't know that the 200-day moving average is right there? The 200-day moving average is like the Chinese Great Wall, they call it, as a joke. It really is. Every money manager kind of looks at it. So again, I said S&P 500 represents 500 companies, the most important 500 companies in the US, right? It tested the 200-day moving average several times, okay? So that's why we use moving averages. That's just one set of overlays for now. There's a lot other ones, these indicators and oscillators. Just kind of ignore them for now. Focus on what you know, which is the candle patterns, or the candlesticks, and the simple moving averages. Keep it simple, because later on, if you get, you become more intermediate, man, I really just trade off the simple stuff. You don't need to be complex. Honestly, I trade off my phone these days because technology has advanced so hard, and it just makes no sense to sit at a desktop anymore. Interesting fact, right? We listened to Intel earnings call. They're moving away from personal computing CPUs and focusing more on data center CPUs, because that seems to be the trend, right? And so a lot of the hot stocks that we analyze in here tied to cloud strategy, data center strategies, it's just the hottest thing in the markets right now. And that's what I kind of focus on. I do have a bias, I admit. If you guys like my bias, you could, let me know too. If not, then that's okay. We need to start focusing on other stocks like financials and stuff. Next week is the intermediate session. I'm gonna do a dissection of the financial industry. Okay, so it's gonna be a little intermediate, but we're gonna focus on that financial industry, like all the financial players, and do a little deep dive into it, like mutual funds, like exactly what do they do, and hedge funds and stuff like that. So that's what I have planned for next week. But anyways, around the world, look, so this is the S&P 500. I really love the fact that it held the 270. Let's draw it right here. 270, right? Because that was the prior support and breakout right here. We had that breakout right here, as you can see, right? And then recently we had a pullback again. I know it looks like we could be setting up for a head and shoulders, so that's something to caution, right? But, huh? Yeah, it looks that way, so we might get some consolidation right here. But the main thing where I'm looking for is clearing the 280, right? Breakouts are bullish, breakouts are bullish, breakdowns are bearish, breakdowns are bearish. Sorry, I repeat, but those are like rules of thumb. Oh, that's not me, right? Okay. Anyway, so that's really the S&P 500. I love the fact that it's above the 20-day moving average. That's a good thing to see. If you guys are a S&P 500 trader, keep in mind that this stuff is the technicals don't work as well as like stocks. They work really well in stocks, but this is an index. An index has so many components tied to it, right? You have many hedge funds and mutual funds, they're all playing the same index. So it doesn't operate the same, but we still, even if we don't play it, we still have to look at it, right? I said day traders who trade intraday, they look at the S&P 500. But, swing traders, investors, we all have to look at it. So that's one right there. So I love the fact that it's above the 21-day moving average and a close above 275. That's good to see. On top of that, the VIX looks really good.
I have a question.
Yeah.
So based on what you're showing, this is how I'm interpreting that if I'm looking at a stock index, if I want to, there are terms, right? They want to buy or hold. That should be determined by the moving averages of the stock index.
So you shouldn't base your entries on the moving averages, right? You can, and there are algorithms, trading algos that do that. So you're a data person, right? So you can. but it's really, at the end of the day, you have to define yourself. What kind of investor or trader do you want to be? Like, do you want to focus on the fundamentals or the macro picture or just purely technicals, right? So there's something called quantitative analysis versus technical analysis. Technical analysis is pretty much what I'm doing right now. Quantitative analysis is like the evolutional form of technical analysis. And it goes into deeper, like, computing, like, okay, if you have a data background, I'm assuming you know this, right? But you could compute data if, let's say, it's how far is it above the 20-day moving average right here. You could compute that difference and then put a number on it and be very quantitative in your trading. So that's why they call it quantitative trading. But for me personally, I'm not, that's another gentleman's expertise. His name is Raj Kumar. He's over in Texas. He joins as well. Damn, JC, 2 days in a row. Oh man, thanks so much for coming again. I know you drive a long way, but hey, I appreciate it, man. We're just talking about the S&P 500 today.
Oh, okay.
Yeah. So I was just mentioning that I love the fact that it's above 275. And keep in mind, feel free to interrupt me anytime if there's something you don't understand, right? I want to make it very understandable today for you guys.
Yeah, I'll do my research on moving average
Yeah.
to understand it more.
Okay, yeah, it's just like a little intro, right? It sets the direction for you and then where you go next. I mean, honestly, it always helps to have a mentor. Personally, for me, I probably wouldn't have learned about volatility as an asset class if I didn't have a good mentor. Like, he took me, whatever he learned over a period of years, he taught me in like, a couple months. So that's the beauty of it. And that's why I take that to value, and I want to meet like people who are doing business out there, like doing deals out there, and say, hey, how are you doing this? How are you structuring this? Like, if the deal's too big, are you using an investment bank as your infrastructure? Or are you doing like little deals where you're just hiring an attorney? So deal sizes matter, but that's another conversation today. So yeah, so S&P 500, guys, it looks really good so far. If we look at the volatility futures, it's been disruptive, right? It's been crazy, but we have some nice high contango again. Anything above 5% is okay in my book, right? I do admit that I am subscribed to this guy's service that you guys probably see in my emails and stuff. His service is okay. I pay $500 a year for this guy, but I don't recommend you guys get it. But you guys could go through me to check out his content. I really just pay for the analytics that he does. I geek out to analytics, but this is just basically my real time of volatility, analyzing volatility. I know you guys are probably like, what is volatility? Just think of right for now, before you guys get into it, for now it's just a derivative of the S&P 500, right? But it's really big. To show you guys how big is the derivatives market, let's see if I have that link. Let's go over here. Like, people kind of underestimate how big is the derivatives market, right? So there's this nice website. It's called demonocracy.info. I'll put it into the group chat. You guys are welcome to join the group chat as well. But I want to show you guys a little glimpse of how big is the derivatives market. And that's so critical, right? Because in 2008, we had a meltdown, basically a meltdown in the derivatives market, in the housing derivatives, mortgage-backed securities, which were basically options of options on, mortgage-backed assets or securities. They say mortgage-backed securities is basically a stock tied to a mortgage. That's layman terms right there. Nothing too complex, but let me show you how big derivatives are. They title this derivatives, the unregulated global casino for banks. So I'm gonna zoom in. Let me know if it's too small on the screen, all right? So right here, you guys know it's $100. Well, this is what $10,000 looks like. And this is what JC's bed looks like right here. 100 million, no, I'm just kidding. And then over here you have 1 billion. That's what 1 billion will look like. And then 1 trillion, right? That's 1 trillion. So let's move down. Over here we have 100 million equals 1 year of work for 3,500 average Americans. And then we'll put a building next to how big this looks. I'm sorry, that was next to 1. Oh, okay, I see what they're doing. Sorry. So this is 1 trillion, right? They're talking about the bank. This is old. This is outdated, by the way. It might be like a few years outdated. Bank of New York Mellon. They have about $1.375 trillion of derivative exposures. Now, what does that mean? right? When we get into a contract, it has to eventually net out. And if you guys know this basic dynamics, you basically know all contracts that are out there. Let me give you an example. You get a mortgage, it's a contract, right? After 30 years, that contract nets out, it disappears, right? That's like an options contract, like a stock contract, every contract. When the contract is in existence, it needs to net out. So basically what this picture is saying is that this bank has $1.375 trillion of contract exposure, right? So they're leveraged, right? Let's see how big is State Street Financial. They have about 1.39 trillion in exposure. Over here is Morgan Stanley, 1.72 trillion in exposure. Over here is Wells Fargo, about 3.332 trillion.
That's current status?
It's probably more now. Yeah.
So this is back in what?
I need to check the posting date, but let me just show you the rest. HSBC, their derivatives exposure, right? So a simple way to think about it is, let's say you buy 100 shares of stock, right? You have 100 shares exposure. What's the value of those 100 shares? It could be like, I don't know, 10,000. So you have 10,000 exposure. And every day your $10,000 fluctuating up and down. For me, I play options only. I shouldn't say only. I do play shares, but I play options. So I have derivative exposures, just not in the trillions. But that's the to gauge the size, right? So let's go all the way down. This is the 9 biggest bank derivative exposure in total consolidated. This is what it looks like. So the derivatives market is huge, all right, guys? 228 trillion. Let's give you guys a gauge of size. Apple is 900 billion. Masayoshi Son's biggest, VC fund is about 93 billion, almost 100 billion. It's not that big. Microsoft, 500 billion. Facebook's probably 550 billion, right? So now you see the sheer size of 228 trillion. Government debt, is it 1920 trillion? JC, you got the number on top of your head? Government debt?
No.
Oh, you don't?
Not on top of my head.
Yeah, I know, right?
Probably around 21 still.
Yeah. So government debt. Let's just pull up. So
is this saying that we're going through that again? The same?
now, in our discussion, you've been online for a while. We escalated to a point where we started analyzing government balance sheet and also Federal Reserve balance sheet, and the dynamic between those two is extremely important. I started to see how they really manipulate money, but let me slowly get into that. I'll explain it to you because I'm going to get them like understanding about like what is investing, why you should invest. It's so critical. Right now, national debt is 21 trillion. So our derivative exposure is a lot more than our national debt, just to give you an understanding, right? And then Sylvia, you asked me like, what is the date? Let me see the date of this post. It's probably been a while. Yeah, unfortunately, I don't have the date, but I would say it's like maybe 2013.
Oh, okay.
Yeah, it's old. 6 years old. Yeah, see? Pretty old. If you want up to date, what does up to date information look like? Typically like this. It hasn't been visualized like in visual capitalists, right? They make it so pretty for people to see. Usually what a hedge fund manager looks at, they look at this, right? And when you see stuff like a pretty interface, that's when you know you're like I wouldn't say a sheep, but like it's for retail people. The professionals, they just look at numbers, and it's just like this. Right? The visuals is what makes it appealing and gets people excited to start looking at it. But anyways, let's go back to our around the world analysis, just to see what's going on.
Do you have a password? Sorry.
Yeah, it's right on the wall. It's KW Coop or CUP Cupertino 479. So if you guys want to use the internet, there's internet as well. But that's the quick analysis of the S&P 500. It's looking good. Futures are looking okay, though. This thing could whip up, guys. Be careful, right? This thing could whip up. So again, I don't recommend this guy's service because he has volatility alerts, but they suck. There's another service that's better, but this one I shouldn't insult him like on, I'm recording this, right? But he's a really good money manager in a sense that he does his work and analysis. It's just, I love, he came from an architect background, and so he computed all the analytics of volatility, and I just really appreciate that. Pratham, I think this is something you, You might want to mute that. Sylvia. Okay. Are you looking for the mute button?
I can't see that, so I'm trying to.
Oh, okay. Yeah, I like the fact that you're on your phone in this meetup. That's pretty cool. Yeah, let me know if you can't see. I could zoom in, all right? Or even turn off the lights over there. But basically, what was I saying? He provides his background is data architect or whatever. So he provides really good analytics on that. And me as like an investor, I just need the analytics. I don't need to go perform the analytics. So you guys start to see my book of tricks here. I'm just outsourcing my analytics. But I myself am the capital deployer. So I'm the gatekeeper of my money. But I pay someone else for my analytics, which you guys can too. You could buy an investment report, but you gotta, don't base everything off the analyst recommendation, right? Anyway, so S&P 500, moving on. So volatility looks good. As you can see, this is his analytics right here. Everything is sort of green except for the volatility of volatility. They call it VVIX. Though we're not talking advanced today. So in maybe 3 weeks from now, we'll start going deep into volatility. I also want to do a short selling series for you guys. So anyways, S&P 500 looks good. QQQ, the NASDAQ. This is another index, and we have to look at it just to kind of get an overview of what's going on in the different segments of the market. This one's above the 21-day moving average as well. I love the fact that it's a close above 175, right? I want to see it clear highs. Overall, this thing, it never really touched the 200-day moving average. So, there's been a lot of fear in the market, I'll tell you that. I was afraid too, but NASDAQ was resilient as hell. So that one looks good. IWM, no, not IWM yet. We'll do Dow Jones now. Again, guys, another index. This one is at the 200-day moving average, so that looks scary. But so far, as you can see, in this game, nothing is perfect, right? So just because it closed below a 200-day moving average doesn't mean it's done. That's something that you kind of have to, start looking in your trading. So you want to sit up here if you can't see?
That's okay.
Okay, all right, yeah. It's funny because this screen is bigger than your phone, but just kidding. So the 200-day moving average, this is really how it works, guys. It just kind of hangs out around here. Let's look at IWM. So Dow Jones bouncing off the 200-day moving average. IWM roaring back up above the 21-day moving average. If it's above the 20-day moving average, to me, it's indication of momentum. People are buying. And so if you're a momentum trader like me, you want to buy when it's above the 20-day moving average. But this is for educational purposes only. You got to be cautious of how you do it. The IWM is the analysis of the small cap. To give you guys a little overview of what is a small cap, I'm going to draw out the market segment. We expanded this over the course of 70 whatever meetups, right? In the beginning, it was just really small, medium, large, right? We had the large cap, the mid cap, and then the small cap, right? And then over time, as we progressed, I built off this this existing framework. I expanded even further. Let me explain. At the very top, we have sovereign players, right? If you were to ask me who are the biggest hedge funds out there, the biggest one is Bridgewater by Ray Dalio. He's the guy who wrote Principles. It's a cool book. But his hedge fund's about, if I recall, oh shoot, I forgot the number. Is it 100 billion? Ray Dalio hedge fund size. Oh, Ray Dalio fund size. Okay, yeah, put in, size. If I recall, it's about 100 billion. Right, I won't allocate time to go look for it, but he's about 100 billion. Masayoshi Son, the CEO of SoftBank and also a venture capitalist and entrepreneur, whatever, his fund's about 100 billion. Sovereign funds, well, Norway is about $1 trillion. You see the size now? So that's why we started analyzing sovereign. And when we talk about the sovereign level, we're talking about gold, oil, and Forex. Because at the sovereign level, what I came to realize is that it's very important to kind of determine what currency are the people using and what currency are they favoring. So when we analyze that level, it's macroeconomics, right? And then we further built onto this thought. I'm going to explain what IWM. IWM is basically an index that tracks this level of the market. So in the market, let's say we have 10,000 stocks in the market. In the market, there's large cap stocks, medium cap, and small cap. So me showing you guys the different indices, we were looking at large, we didn't look at middle market index, and then we're looking at small cap. right? So that's what I just did. But building off the new framework that I have in my head, after the sovereign is the corporations, the enterprises, right? And then after that, we have middle market, right? And then below middle market, we have small cap. Below small cap, we have SMB. SMB is probably similar to micro cap. And then below SMB, can anyone guess what it is? The consumer or retail, right? That's like the smallest balance sheet out there, not as an insult, the smallest income statement out there, right? If you were to analyze this from top down, who has the biggest balance sheet? Basically meaning net worth, right? The sovereign has the biggest net worth, hands down. After that is enterprises like Apple. Though, you know, Apple, Facebook, Amazon, they're getting to the size of like some countries out there. So they beat some sovereigns out there. And then after that, we have middle market. Middle market is probably like a 50 million in revenue. Or some people like to look at it in a different way, like enterprise is 100 employees and above. So that's why when we go out into the business world, right? If I was an investment banker and I'm going out there looking for deals, mergers and acquisition deals, and I'm talking to like the CEO, I'd be like, hey, how many employees you got? Or what's your revenue? Ah, you're middle market. Or you're SMB. I'm a business broker. You're a consumer. I'm a real estate agent. You see which market I'm kind of playing? As a real estate agent, I focus on getting deals here. As a business broker, you would focus getting on deals here. If you guys don't know what a business broker is, basically there's a cafe out there, a restaurant out there. You can sell those entities and you can buy it. So people get tired after operating it for a while and they just want to exit the business. But you kind of can't stop. Like if I stop running these meetups, you know, JC might one day come into like a closed door. Sorry, JC, I'm just kidding. But that's really what it is. Like you guys are kind of like a business to me, but not really, because to me this is really nonprofit. I do it for just the relationships and you know, see if we could do something together. Yeah.
About the large, medium, and small. So is it like the total market capital cap of all the large is smaller than the small?
No, it's really the size of the company. So Shati, I'll show you so we like to look at the scanner, right? In the scanner, we like to organize from the biggest company down. So this is it right here. Apple is the biggest player at 944 billion. And so the large cap index, like the S&P 500, let's say right now there's like 369 pages, right? 7,000 stocks. The S&P 500 only looks at the top 500 because the top 500 has the most heavy weight. And so whatever that weight is moving around in the economy, that's what we're really analyzing. Yeah. And that's why the S&P 500 is so important.
So who has the higher weight? Like
Sovereign.
Large cap or the small cap?
Large cap.
Large cap.
Small cap is smaller companies. If you want the exact size, what you could do is go over here and look at the market cap. And you see how small, right here? Small is 300 million to 2 billion in size. So whatever company you work at right now, if you guys work at a startup, or if you work at, let's say, Western Digital, you work at Western Digital, right? Let's see the size of Western Digital. That one's probably a large cap. So Western Digital, 23 billion. 23 billion by this screener standard is large cap. Because anything over 10 billion is large. And then there's mega. Mega cap is like, these are like blue chips right here. Mega cap is like Facebook, Amazon.
The FANG.
Yeah, the FANGs. Yeah. And that's why we want to analyze those mega caps. Because if those mega caps can't make money, well, they're not betting big enough on like a market opportunity, right? So, you know, as a, you know, maybe potentially an aspiring real estate agent, me, right? You know, I might want to get into smart home products because I told you guys in one session that why is it that we go to Best Buy or what other tech places, Best Buy or Target, and we're seeing a heavy push of like home goods, home tech, connected appliances. That's a huge market opportunity. Remember, guys, we have to use these mega caps expression to our advantage. If these mega caps are doing something like introducing Apple HomePod is not a small, tiny market. It's a big market. And so if you become a consultant or an expert at Apple HomePod, hey, there's big money for you. I'm assuming that Apple did their homework. And so it makes sense for you to invest your time there. Kind of interesting how these mega caps influence our culture and our thinking, right? Like, anyways, I know I kind of digress, but this is the current framework that we have in our head that I've developed so far. You guys have any comments, like JC or Sylvia? Like, the biggest player I've seen out there is a sovereign. The biggest hedge fund's only 100 billion. The biggest sovereign's like 800 billion on average, or some of the biggest players. So sovereign meaning like the government has their own hedge fund, but not really. Some do, like the Abu Dhabi fund, is it? That's a $700 billion fund in Dubai. We have to pay attention to these funds because they're protecting money, right? And so if we want to try and forecast like a crash, we got to see what they're doing. What are they buying? Where are they putting their money? Though I'm too small fish to kind of look up there. I like to look up there, just like a little peek. But I focus more on stocks, which is what you guys came here today. So that's our framework, all right, guys? So I showed you guys volatility. We looked at the indices. Let's look at what's going on around the world, just to get a quick understanding. And then by the hour, we'll jump into the basics of stocks, and then we'll talk about what's going to happen next week. Let me see, where is our futures? So we have to look around the world and see what's going on. This week, the indices, they did pretty okay. So my advice to you guys starting out, start looking at the indices as like a starter, but you don't have to invest in that. Look at it to understand where our economy is going. And then as you build more confidence, you could play, in combination with stocks and the indices. But pay attention to the indices. Dow Jones, S&P 500, NASDAQ, Russell. These are international indices. We won't really, you won't have to look at it now because you might want to just focus on US. US is the biggest index right now. So VIX is breaking down, which I like to see. All right, guys. Nikkei. I don't have my moving averages on these, but let's look at the weekly. I like that bounce right here. It's still uptrend to me. Let me know if you guys have any comments on that. Europe, right? A Europe index. So understand that there's US, Asia, and Europe. These are the major indices around the world.
So Nikkei represents Asia.
Japan. Yeah, Nikkei. And then the Euro Stoxx 50, Europe. There are other indices. DAX is Germany, right? It's really, the way Finviz really did this beautifully, in my opinion, is they organized like the most important indices in the world by major economies. So this is enough to tell you what's going on in the world, but I think most people don't know how to look at it. Oil, guys, like I mentioned last week, oil stocks are hot. This week, same thing. If you were to perform a scan, you'll still see oil. So as you see, oil kind of bottom, 2016, breakout right here, going higher. Bonds, little consolidation, but to me, kind of setting up to go down because we're raising interest rates right now. That's something you guys have to, when you hear interest rates, you gotta think, that's big stuff. It's really big. It means a lot to this economy, right? But just a little quick overview for, I don't wanna get too advanced. Setting up to kind of looking further downside because we're raising interest rates. If interest rates go up, these are bonds, so bond prices go down. Softs I don't really look at. For commodities, let's just look at, instead of me pulling up all the commodities, let's just look at DBC, the ETF. Because this kind of tracks like the commodities complex, or the segment. You don't really need to look at everything. So commodities are cheap in this overvalued market. For you guys coming in, stocks, bonds, and real estate, they're all kind of expensive right now. But we just have to play with what, it's like your upbringing, you're born poor, rich, doesn't matter. You gotta figure out how to make it. That's the nature of this game too. So back to the future. So that's DBC. DBC is the a commodities index showing you what's going on. So we won't look at all that. Let's look at gold. I saw some action in gold, but it's been looking not too good. In terms, this is silver. Now, why do we look at gold? Because the sovereigns look at gold, but I won't comment too much. This is what it looks like. It's kind of going down. The gold ETF right here is kind of bouncing, in case you guys want to look at that. But no matter where I go, the hedge fund players, they still like gold as a protection against the sovereign. So again, it's a super macro play. Us smaller fish, we can't really benefit from that, but it helps to analyze.
Why is gold going down?
Dollar's going up. But JC, we were talking about gold and dollar Last week we had like a 5-hour meetup. It was crazy. But we were saying something about gold last week, if I recall.
Yeah, well.
Like, it's not just the dollar that's causing it to go down.
Well, what I was trying to say is that gold and like the US dollar, sometimes they don't, majority of the time they kind of go together. If you look at the long-term picture, it's not, sometimes they diverge quite a bit.
Yeah.
But what does affect gold is inflation expectations.
Okay. Yeah, see.
So that was what we were talking about.
Yeah.
Last week, is just inflation expectations are the biggest thing for gold and silver. Because
Yeah.
the higher they go, the worse the gold is.
Yeah. So Sylvia, I'm not a gold expert, though I did read like 200-page reports on gold. But my takeaway of that was like the instability of the macroeconomics right now at the sovereign level. And that's why gold seems to be a consideration. But it's not for us, basic people, I feel. That's my takeaway. Anyways, looking at currencies, the dollar. No, for you guys have to start looking at the dollar. In my, early on, I totally ignored the dollar. The dollar is so important. We won't go into specifics today. I just want to point out today that the dollar is sort of breaking down right here, right? We had this, dollar rally off right here, this pattern, but now we're breaking down. All right. So the longer trend, a lot of money managers say, is that the dollar is going to go down, which is good for our economy. Again, we're not going to talk about that. So that's the around the world look. Did I miss anything? Cryptocurrencies. Anyone interested in cryptocurrencies? I'm interested in cryptocurrencies.
If there is inflation, dollar goes down or up? If inflation goes up.
I don't know. JC, can you help me with that? I don't know.
What was the question?
If inflation goes up, what happens to a dollar? I don't have the dynamic in my head, so I can't, or like the confidence of the dynamic. Like I would have to like kind of reread it and then explain it to you. But that's a good question. Maybe we could search that up. I won't search it up now. Dollar and inflation relationship. This is a reminder to kind of look at later. So we'll circle back on that. Going to cryptocurrencies. This is what I'm seeing with cryptocurrencies, guys. I think Ethereum kind of hit like a short-term bottom. If we pull up the hourly chart, right? This is a closer look. Again, for you guys coming in, we normally look at the daily, but sometimes we flip to the hourly chart. You have to understand time frame. We're flipping to this to just kind of see, what's going on. So I saw bottoming action at 400. Raj was looking at 410. I'm pretty sure this was Raj right here. No, I'm just kidding. That's a lot of money. And then I saw 450 consolidate. So if you guys want to do a quick technical analysis, this is a technique that you guys have to use to analyze like how to base your risk reward. I saw a line at 450 right there, right? And there's a pattern. In the beginning, it might be kind of scary, right? You guys are like, it's too much, but it requires repetition. I myself, I remember in the beginning, I was at Online Trading Academy. If you guys know that organization, they charge you like $20,000 for like 2 weeks. I was digesting it slowly. It takes a while. But after a while, you become more confident and you understand what's going on. So I hope not to intimidate you guys, but to kind of inspire you guys to pursue a path in investing because it's so important. So with that being said, last comment on cryptocurrency, I'm seeing some action, maybe something to consider. 6,000 bounce on Bitcoin. Let's go into the basics of everything. So let's see why. Okay, so the question is why should we, why should we learn how to invest in stocks, right? I think for the people who came for some time now know that it's so important, right? You have your own government devaluing your money. If you don't pay attention to that, then why do you put so much time into building a resume, get a job, so that they could take away part of your money through the form of inflation, right, which is devaluing your money, through the form of taxes, multiple types of taxes, investment taxes, right, capital gains tax, property taxes, sales taxes. They take a lot of money because they have a poor balance sheet, and that's what we analyze. They're like I like to joke and say they're like your second spouse that has a bad spending problem. And if you're married, you kind of understand you share a balance sheet and income statement. You share a financial profile, basically. And so the government's kind of like your second spouse, where they're borrowing on your behalf and you're paying it later. That's the nature of the game. So that's the common thing that I see among hedge fund managers. You know, they get deep into finance because they know, you know, the worth of the dollar or their economic value, and they don't want to get suckered. I mean, at least I feel that way. I'm not a money manager or anything, but so you know, that's a little introduction as to like why should we learn about the stock market? Why does it exist? First of all, the existence of the stock market is basically, well, let me ask you guys, why do you guys think the stock market exists before I kind of explain? Any feedback? Like, it's just there.
To raise money for a company.
There you go. That's one way. Now, the thing that I want to point out is, like, have you guys noticed that in an advanced economy, there's a stock exchange, but in a less advanced economy, now there might be a stock exchange, but it's not as developed. So having a stock exchange is a technologically advanced feature of an economy. It's electronic. Well, I mean, it wasn't before, but you're right. It's important to help. It's really, the basics of it is to transition people with money who have too much money and maybe a little time for ventures, transfer it over to other entities or people with ideas. Right? And so me trying to host these mixers coming up, I don't know when, maybe in the next 2-3 weeks, we're going to try and get 40, 80 people in here. We're going to try and get investors and co-founders to network. Yeah. So, you know, if you guys, there's many reasons to come. Grow your network, right? Your network is your net worth. The more people you know, the more likely you don't have to cold call for deals. That's really the beauty of it. It could help you find a job if you're looking for a job, and it could help you learn about emerging market opportunities, like where to invest. Sometimes these entrepreneurs, they might not have a macro understanding, but they see the next step in technological advancements, and maybe we could learn from them. It's kind of weird. I'm increasingly paying attention more to venture capital. It just seems that, you know, I put a comment in this deck or word saying that wherever I went, okay, I pivoted like 7 organizations now. Keller Williams is my 7th organization. The funny thing is, wherever I went, technology is everywhere. It's always a smack in the face for me, and now I work in technology. Let me explain why. Reason being is, you know, well, starting off with Silicon Valley Bank, that's a tech bank already. They're already funding technology, disruptive companies. But when I went to Morgan Stanley, I saw that their technology stack was outdated, and they're so big that they have to go through a lot of security checks just to get new technology. So that's detrimental to their growth and business. For me to remain with Morgan Stanley, the issue would be I wouldn't learn about new technology, and every transaction I make, they say, oh, you bought a home, disclose it. You sold your home, disclose it. You bought the stock, disclose it. So I didn't like that, right? But it really showed me the compare and contrast between a startup and how advanced a startup is, and also, you know, versus a legacy company and how outdated that legacy company is. So when you guys invest for the first time in the stock market, I know I have a bias towards tech, but you guys want to focus on the new next-gen enterprises. Don't focus on legacy. You can focus on legacy for like dividends, right? Like fundamental long-term investing, like maybe GE, but not a recommendation. I work at GE. But just analyzing all the stocks in there, the tech, the next-gen enterprises, they have the best efficiencies. That's why. So now coming over to Keller Williams, tech hit me again. I just found out that they're sort of rebranding themselves as like a tech real estate agency firm. Just because there's technology out there that could help people broker a home now. That almost sounds like electronic trading. Back then, a stockbroker made a ton of money because transaction fees were great. But with technology, that fee, that margin disappeared like the VCR. So for me to go to Morgan Stanley and be a stockbroker, right? They licensed me up, be a stockbroker. It didn't make sense. That model to me, looking at the economics of it, it's dying, right? And so they're becoming pure wealth management. The whole stockbroker days doesn't exist anymore. Today, it's electronic stockbrokers like Charles Schwab, TD Ameritrade, E-Trade, Scottrade, whatever. So you guys have the benefit of that as a retail investor. When I was in Morgan Stanley, they charge $100 a transaction. Employees get 50% off. That's $50 a trade. Now I have TradeStation or whatever, right? $5 a trade. I'll take that all day rather than $50 a trade. So I hope I can help you guys recognize the beauty of being outside a financial institution versus working for a financial institution. If you're someone who's passionate about finance, pursue your own path rather than go work in, well, you know, that's biased. You could work in there and learn the ropes, but if you really want to excel in finance, you might want to leave. So the big takeaway is that you guys out here, don't lack confidence that they're better than you on the inside, like a financial institution. We have just as much manpower or technological power on the outside compared to them. To be honest, they actually hire like outside consulting firms to give them opinions on like market direction, right? Because there's a big difference from a money manager who passionately likes, you know, like learning about this stuff and a 9-to-5 money manager. You see what I mean? So if you guys look at the sovereign funds, the biggest funds in the world, they have internal money managers and external money managers. Interesting, right? So that's why you guys should you know, be confident in the technology. So example, I showed you this. I have analytics from a guy who, I think he went to Stanford or whatever. He put it all together. I'll pay him. I'll take it. But I get the analytics. In the coming days, we will talk more about this. I'll share this one with you guys. But for now, going back to the discussion to you know, the basics, right? So that's why the stock market exists, right? It's really an intermediary apparatus to help funds transfer. And if with anything with economics and finance, the quicker money flows, the better. The more lubricant, I hate to use that word, in the system, the better, because the faster money flows, everyone, it's like, the best example is kind of, I don't drink alcohol, right? But I'm going to use an alcohol example. It's like alcohol at a party. The more the alcohol is flowing, you know, in theory, the party's good, right? Or it could become like a shit show. Excuse my language. But that's really the same thing with money. We want money to flow like alcohol at a party, in a good way. Yeah.
That's what they keep referring to the Federal Reserve taking the punch bowl away.
Oh, really? Taking the punch bowl. Yeah, you're right. So that what JC just said is that if you understand the game long enough at the macro level, they're printing money. It's the same. They're printing money to devalue your money, right? And if you don't invest, well, the informed people, right? Imagine like, I don't know, people who don't have an education, immigrants who don't know anything about money, but they know business, that's okay. But your assets get devalued, man. And so this is, you know, I hope this is not a waste of your time, whatever we talk about today, I hope. Anyways, so that's the existence of a stock market, right? Now, let's talk about the creation of money. We kind of dabble, right? You know, why are we creating money? Or just understand that unit of value. There are billions of people in the world with different financial profiles, right? Some people have more, some people have less, and so people with more usually invest that money, while the people who have less time go seek that financing. Just a basic dynamic that you guys should understand. We already talked about the technologically advanced economy, right? Me saying that an advanced economy has a stock exchange and the lubricant versus, I shouldn't say third world, but a lesser developed economy. If you were to, let's say, I'm K, right? So if you were to take me and you throw me into like a random planet, an alien planet, I'll figure out how to survive through economics. I'll find where the exchange is at and I'll learn to trade it. Because trading is a very universal activity, I feel. It's a transaction. It's almost like mathematics, right? If you believe in aliens or whatever, but they say you can communicate with aliens through mathematics. Well, I think you could also communicate through trading, right? My marbles were your marbles or whatever, right? But anyways, that's I kind of explained that one already. Let's talk about how money is always in motion, right? Like the punch bowl example. You guys have to learn that your money is not safe in the bank. And the best way to explain that, and we talked about this 2, 3, 4 times already here, is fractional reserve banking, right? But it doesn't hurt to review because the more you have this concept in your head, the better. So let me give you an example of how money is printed and how your money is not safe in the bank, right? So you kind of have to sort of follow my mouse here. We have one depositor, $1,000. You deposit the money into the bank, right? That bank will hold 100 as reserve, and they will lend out 90% of it to another person. That person now spends it on a home or whatever, $900. This person takes that money, brings it to another bank, and then that bank, holds the money, and they reserve 90%, and then they lend it out to this guy. This guy spends it on this guy, and then that guy takes the money and brings it to another bank. We literally do that over and over and over and over, right? So let's say there's $1,000 of real money in the system, but we can multiply that to like 10,000. So that's why in finance they talk about bank run, because you don't have confidence in the bank anymore. We all decide to pull out, but they don't really have the money to supply everyone, right? But now on the flip side, they tell you there's this guarantee of a FDIC insurance fund. We guarantee up to 200. Is it 250 or 200K? I forget. Yeah, we guarantee up to $250,000. And I like to use this picture from that website I showed you earlier. They don't really have the ability to service that, right? So this is what $100 million looks like going down. I think I showed this picture like 2-3 times before. But basically, this is the FDIC fund, $25 billion. They guarantee $25 billion, right? But how much money is in existence? Right here. This is how much money is in existence through multiplication. And this is their fund. So in reality, if you don't learn to invest or manage your own asset, become an asset manager, part-time is even enough. You don't need to be full-time asset manager, but part-time. Just be aware, right? They really can't supply the need if things were to go bust. So that's the reason why we care about investing in stocks and stuff. Moving along, a world of fiat currency, right? Have you guys heard of fiat currency before? No? Here's the definition of it. Fiat money is currency that a government has declared to be legal tender, but it's not backed by a physical commodity. The value of fiat money is derived from the relationship between supply and demand rather than the value of the material from which the money is made. This is so critical to know in trading and investing because it's basically saying that the government has the ability to print money left and right. And when they print money, that's how stocks go up. I mean, one component of how stocks go up, right? So the other component is that the stock's making a lot of money. It's a great business. So there's two ways to think of it. But here, I just thought this was a cool cartoon since we like to talk about cryptocurrencies as well. Difference between cryptocurrencies and fiat currency. Fiat is issued by the government, cryptocurrency generated by computers, right? Just skipping ahead, decentralized, centralized, digital medium exchange versus physical, limited supply versus unlimited supply. The difference over here looks lucrative in a world where every government is kind of printing money. So, I wouldn't turn my eye away from cryptocurrencies just yet. I'm not recommending anything. It's just educational opinion. Something might come out of it, And I mean, if you look at everything in hindsight, it's all easy, right? Like if we knew the internet was going to be as big as it is today, how critically important it is. Like, how stressed are you when the internet goes out? When you don't have internet? I stress like hell. No, I'm kidding. But that's the power of the internet. When I went to a cryptocurrency event, there were so many Chinese people. Recently, when I met with Dr. Yang, Dr. Yang he's sort of a VC investor and works at a startup, I guess. He has a lot of connections in China. He's gonna probably come in. You guys can meet him too. And he has a ton of connections. And he basically said he's bullish on cryptocurrencies because SK, another gentleman that comes in, he asked. SK is an Indian gentleman that works at Intel. He asked, hey, what do you think of cryptocurrencies? And the guy goes, well, in China, the people don't like the government. And so they are very optimistic about cryptocurrency. That was his opinion. And when I went to a cryptocurrency event, there were so many Chinese people in the room. Well, the event was Chinese focused, but it was a mix. But majority of it, this was when Bitcoin was at its bottom. Was it 6,000 or 5,000? I forget. Whatever bottom that was, I went to an event. That event was still like a party. It was packed. I do have video. I think I shared it with the Telegram, but it just kind of goes to show that there's a belief behind this technology. And one of the speakers at that event was a LinkedIn co-founder. And this guy basically said, like, he was a CTO at LinkedIn, a CTO co-founder. He's an Asian guy. He basically said, you know, what he sees here is very similar to like the early 90s of the internet, or 80s, whatever. I wasn't there to, you know, it's a baby, or not in existence. I wouldn't even know. But he's seeing things repeating itself. And you know, this time around, if I was who I am today in 2008, I would capitalize on that whole move. But I'm not. I am where I am today, where my economic standing is where I am today. So I'm going to assess the chess pieces, guys. I'm going to share it with you guys. If you guys like it, then you could capitalize on it too. But that's where I'm at. That's the situation right now. So keep in mind, we have a government who prints money, and when they print money, we want to see that because the more punch bowl we get, the higher stocks travel. As of late, you guys are learning about stocks right now. We're in a time where they're sort of taking away the punch bowl or raising interest rates. So stocks kind of have a headwind, but that doesn't mean it still can't go up. So that's why you have to become a very good analyzer of stocks. And we'll jump into that in a bit. Financial system economic framework. Below is an image showing the participants on the left with excess money and the participants on the right with borrowing/funding needs. Basically, we have the markets, right, and the financial intermediaries. They basically, you know, hang out pretty close to the markets. That's just their thing. But then you have over here the borrowers of money, people who want to borrow for a home, people who want to save and invest and lend for someone to borrow a home, right? And it's not just it's not just individuals, it's also entities like companies. Companies need to lend money too, and governments. It's just I guess, an important framework that I share with you guys because this is what we learn in finance and economics, which I think is, you know, pretty essential for like everyone to know, but I guess economics isn't like a mandatory prerequisite or course in college, right? Just understand that's the system. Economic system native. So last comments before we jump into stocks. By default, you're a player in the system, whether you like it or not, right? I talked about it in the past, like 50 sessions ago. Even a 16-year-old is playing the game because you're transacting with money. Money is the language here. And so the bottom line is, if you choose not to care about how money works or investing, then your efforts/resources in life will always be devalued by the controller of that fiat money. I hope that makes sense because I explained the fiat money and all that. But that's a little basis as to like why you should learn to invest, right, guys? Nothing too. I might sound excited, but yeah, let me know that was okay. So let's jump into the stocks. When you guys want to start learning how to invest, right? The basic understanding. If I were to redo it all over again, knowing who I am today, call myself a newbie again. You have to decide what type of investor you want to be. Segmentation is so critical, right? Up here we have, you know, Warren Buffett. Warren Buffett is more of a value investor, he calls it, but value, I would call him more of a value buyout guy. He buys out the entire company and he just holds it and collects dividends. So that's something we can't do as like, you know, someone with 100K, let's say. You can't really do that. Well, you could buy a cafe actually for 100K. But that's another realm that we talk about. George Soros, this guy to me is like the hedge fund manager. He's a macro player. He bets on macro situations, but he bets on stocks too if you analyze his portfolio. But he's known to be the guy who made $1 billion in one day with a lot of leverage. 1 billion beat in one day. The other guy we have is Paul Tudor Jones. I've been wanting to show you guys this clip from, or maybe even the video. He had a movie that he banned from the U.S. Does that make me a criminal if I own that? But anyways, he banned it because he was really arrogant in the video as a trader. But it showed him a video of him being a S&P 500 futures trader. And he would just be on the phone banging it, because back then they trade through the phones, saying like, get me into this many contracts of E-minis. I want it now, blah, 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 right? Because he's day trading the S&P 500 futures. But today he's more of a passive asset manager. So is that someone you aspire to be? It helps to kind of understand. I'm not forcing you guys to figure out who you want to be, but just to kind of think about it. Here's another money manager, Steve Cohen. this guy, he's a trader. He's by the monitor all day long. Something I can't do, but I need to figure out how to do it one day. Maybe when I finally quit my 9-to-5 job, I'll be at the monitor all day, and then after that, I'll go build a real estate business or something. This guy, he would even trade like a distressed business, right? Stocks that are beaten down, and then try to, you know, pump it up. Be like, you could be an activist investor. That's more of a, oh boy, I forgot his name. Activist investor, the guy with the gray hair. Damn, I forgot his name. Anyways, or you want to be in private equity, like these two, right? These two guys are founders of KKR. KKR is like, if you guys watch Barbarians at the Gate, that's what that movie's about. It's about KKR, early days of KKR acquiring the biggest acquisition in the world, or at that time, right? And so these guys, what do they do? This is a different form of trading investing. Basically, at a micro level, we could buy a cafe. Yeah.
Carl Icahn.
Oh, yeah. Who said that? Who got that? Oh, wow. Okay. I didn't know how many people were online. Jeez, that's a lot. Yeah, you got me, man. Bill. Oh, yeah. Bill Ackman and Carl Icahn. They're both activist investors. Hey, guys, welcome online. I totally like, you know, there's people here too. Yeah, welcome online. All right, guys. Thanks for pointing that out. I didn't see it. So these two guys, basically what do? Private equity. You guys hear, okay, private equity is kind of like a term that's used in like two ways. One way is like it's a strategy. The other way, it's a particular umbrella term for venture capital and leverage buyouts. But basically what these guys do is they go out there and they assess a company. Let's say someone like a beaten down stock like GE, right? They'll look at GE and they'll be like, oh, we'll take on that bad debt, we'll take on those financials, we'll flip it, we'll restructure it, right? And they'll flip the business. It's like flipping a home. So private equity, they go in there, they acquire majority of the shares. However you want to do it. If it's a private company, then it's more of a phone call and doing deals, right? It's a sales thing. Sales and business equals the same thing. But if it's like, where was I going with this? Well, I forgot. Anyways, they would buy out like a distressed business that they think could be profitable. They go in there, they restructure it, and then they sell it back to the market. Either sell it to another wealthy investor who sees the multiple, they like it. The multiple meaning how long does it take for them to break even, right? If they like it, they'll buy out, and then the other player exits. It's a negotiating game out there. Or they redeploy it into the stock market where us investors buy. So when you hear an IPO, it's very similar to when I say private equity. What they did, they flip a business and then they flip it on you, you buy that. Well, Peter Thiel does it a little bit different. He develops it from the ground up, and then they IPO it and they flip it on us. Most people don't know that IPOs are being flipped on us. They think like, oh, I'm gonna be the first to buy that. Dude, you're like, I would say almost last, maybe. Maybe first in the public market, but you're last in the private markets. How do you get access to these deals? Well, you could network at our 40 to 80 people, tech mixer that we're going to host. If I find the deals in there, I give them to the first people that come in mind, or I'll formulate, make it work somehow. That's one way to get in first, or be an angel investor, or a venture capitalist like Peter Thiel. So he's funding these stocks essentially, or these companies before they go public for stocks for you guys to trade. So. Again, figure out what type of investor you want to become, or what you find interesting, and then eventually mold yourself to be that way. What you learn here about analyzing stocks is not a waste of time, because as we learn in this club, it spreads on to every single business. You could learn how to manage your own financials. You could learn to assess a cafe or a restaurant's financials. You could look at stock financials, or even a startup financial, whatever. But you become an artist at that. In understanding and maybe manipulation. That's the cool part. That's the restructuring part. So let me give you an example of like how can you buy out a company and bring value to it, right? I think I have a picture below. This picture below right here, this is the basics, 101 of every business, right? Have you guys noticed that every business has very define functional areas in business, right? And we could sell technology to this, like Workday. Workday does HR. HR is right here, human resources. Workday's a very bullish looking stock, not a recommendation. But if we look at this, every organization looks like this, like straight up. Every organization, in the middle you got the business. On the left you have the operations, right? Someone like Tim Cook as an operator, Tim Cook of Apple. You have a HR division. Basically, there's sales. You guys believe that there's sales in HR? Recruiters. They're salespeople. Sales in a different way, employment way, right? And they have their own like CRM. They have their own software to manage the employee turnover and all that. Why is this important? Let me explain real quick. You kind of need to know this when you want to analyze a stock deep down. You need to analyze each division, like how organized are they in their HR? How organized are they in operations? Because it ties to the value in some way, if you're doing deep analysis. So every organization has HR. Every organization has an accounting, right? Every deal that you get, who facilitates that? Besides like the attorney doing the contracts, the accountant tracks all the financials for the finance department to analyze, or for us investors to analyze, right? Financing, the borrowing of money and management of money. That's kind of self-explanatory, right? Apple, I think they have about 327 billion in cash. Like cash as in anything that mimics less than 1 year. Like something that you can sell less than 1 year. So it's pretty much cash, right? Because if you buy a stock and you're locked in, or let's say your 401k, you're locked in until 65, that's not really cash. That's a security, right? So they have 327 billion in cash. And you think it sits around? No, they have a, when an enterprise escalates to a certain level, they have a manager, an FP&A or whatever, or a CFO that manages that 327 billion in cash. So you could kind of say Apple has a hedge fund inside, maybe, not really a hedge fund, depending on how they deploy the capital, right? If you start betting like a hedge fund, then I think you're a hedge fund. Though there are some sovereign funds that are very, that mimics hedge funds. Anyways, there's marketing and sales. That's like the bread and butter right there. At least I might be biased in saying that. Everything else is administration. There's also R&D, or like development engineering, right? You guys have to go out there and develop like, the infrastructure and the software. That's hardcore. That's a lot of work. I don't have experience in that, but a lot of people who come in here do. My expertise is in finance, probably accounting a little bit, and mostly sales and marketing as well. Finance, sales, and marketing. Why is the sales and marketing so important? If you go out there and start a business today, what do you care about? How much money you make, right? The sales. And then after your expenses, your earnings. So being a good salesperson, I know there's been a stereotype that salespeople are like, don't talk to them. But hey man, like when you become more wise and you cross away from a consumer, right? Someone who just consumes all day, all week, like, go eat too much, or not too much, but just you spend most of your days eating, spending. Someday you're gonna cut back and say, hey, I need to start saving. And then you become more minimalistic. And at some point you're like, hey, I wanna make more money. That's when you become a producer. So when you say you wanna start making more money, you gotta learn sales. Right? It's weird, but it's how the world works. It's a dynamic between the two. There's people out there, like July 4th, people want to consume that activity, right? Like go barbecue, watch fireworks. They want to consume fireworks. Well, no one thinks about who has to produce the fireworks, right? You guys want to consume the content that I have to produce it. And so it's kind of hitting the limits as of recently with like 77 sessions. I try to make it interesting, but like I said, it's like that mile run. You improve your mile run down to 4 minutes. That next 10 seconds of improvement is hard. If you're looking for the bathroom, it's just straight out to the right. It's nice and cold in there. Not that it's not hot in here, right? You guys are okay? Yeah. So that's the organizational, functional areas that you have to understand, because when we look at stocks, there's a ton of stocks that are like infrastructure stocks that just basically invest in a specific segment. So for example, some hot stocks that I like, not a recommendation, For human resources, Workday. I love that stock. I really like that stock. Sales, CRM. Marketing, Marketo. You see what we're doing here? We're investing in infrastructure. It's a lot more safe than, you look at like, I guess, maybe a Twitter, but I shouldn't insult Twitter. Twitter is kind of like just more B2C. Everything here is B2B, business to business, versus business to consumers. That's the difference. So I want you guys to be aware that every organization has the same function, these functional areas. It's just wise to know as we learn how to jump into stocks. I know it might be, at this point, a little tedious hearing me talk, but it's really my endeavor, or like I'm trying to prep you guys to like really come at it like with a good standing, rather than just like throw you in there and you're like, what do I do? So again, going back to what type of investor, right? So within the world of investing, there's different titles, they call it. You want to be a value investor. Example of a value investor is you're buying something really cheap. And in our experience in this club, well, value investing is cool, right? Like Simon Property Group or Gilead Science. These are companies with 5 stars. Let me show you. But they haven't been performing for years. Oh, okay, not years. Sorry, months. For example, here's Gilead Science, right? If you look at the monthly, a longer term picture, we were looking at this over here. I mean, nice trading opportunities, but it hasn't appreciated back to the 120 levels where it was before. But look at the valuation right now, right? So to give you a little context of where we're at, most S&P 500 companies right now are trading about a 22, 27 multiple. This one's about 11. So it's undervalued in terms of a earnings multiple. Balance sheet wise is 4 times the balance sheet. So maybe not undervalued in that sense, right? You might, to find value stocks, you might want to find something that's like a 1-to-1. Right? And if you guys don't know about stocks, this right here is basically finviz.com. It's a scanner, right? Because there's 10,000 stocks out there and you're scanning for opportunities, right? Same thing with me. Like as let's say like enterprise salesperson, I'm out there, I'm filtering and scanning for business opportunities. Sales is like trading, hands down. It's emotional, especially when you get rejected. But the beauty is that you keep getting rejected, and that's what makes you tough. And then you go out there and you get deals or whatever. But that's not what we're talking about. So that's an example of like a cheap multiple in terms of like income, right? Another one is Simon Property Group. Check this one out. Hasn't moved much, but we've been watching this. Why do I look at this? These are 5-star securities on Morningstar. Morningstar is like a mutual fund / hedge fund level. What do you call it? Platform for investors. Yeah, I mean, they gave it 5 stars, but it hasn't been performing. Maybe in terms of like dividend, nice dividend, 4.51%. Right? Let's see. Let's go back to it. So that's being a value investor. Now, how about growth and momentum investor? That's pretty much me. That's what I like to do. And when I hunt for these plays, I'm looking for a technical setup, something that sales and earnings look not like this, but more of a CRM-like. Right? Where sales are just like growing like crazy. This is like the most simplistic form of analysis if you were to look for a stock. You want to see that earnings and sales are going up. Right? If you know earnings and sales are going up, check out the performance of the stock. So that's what I try to focus on. I'm trying to be I shouldn't say I try to be, it's just in practice it led me to be a momentum and growth investor. Funny, because like if you listen to a lot of money managers, they always joke like, oh, you want to know who's rich? It's usually the growth analysts, the growth investment analysts. I kind of agree. There are ways to kind of capture this play, but that's an example of a growth investor. Income dividend investor, right? You're looking for dividends like REITs, real estate investment trusts. They pay high dividends, but you have to really analyze the cash flow, because where does the dividend come from? It comes from sales and earnings. So again, you gotta look at sales and earnings. Are you an opportunistic event-driven investor? I don't even know if that's even called an investor, but you're investing in like a macro theme that's occurring out there. So something like, I guess the gold example, right? where we don't really, trust our sovereign, what they're doing with the fiat currency, printing money. So that sets up a macro event-driven opportunity to consider gold. But we don't know if that's going to play out as well. That's an example of a macro event-driven play, or opportunistic play. Venture capital is a great example of an opportunistic investor. If we know data centers and cloud is going to be like the next big thing, there's going to be a ton of money rolling into that place. So why don't we invest there? Even though the company has no growth in sales or earnings. You see what I mean by opportunistic? It could be a company that doesn't make money, but because we have conviction in this macro opportunistic trend, we're going to play it. And sometimes you need to know that, because when you're analyzing stocks, you jump around like that, right? Sometimes you might see me like pick a stock and you're like, dude, okay, this company makes no money, man. Well, dude, it's the opportunistic opportunity. Just kidding. I'm sorry. So that was opportunistic or event-driven, like let's say like an earnings blowout, or rumors of like a company getting sued. That's event-driven. Macro is more of like the data center and the gold play. So that's something you have to think about as you come into stocks, right? What type of investor? So are you guys aware of like what type of traders there are out there? Because like you guys don't want to be an investor, you can be a trader too. So just like a little quick example like of the different types of traders out there, right? There are scalpers. I'm not a scalper. I think that's kind of crazy. I think if you do that too much, you probably start ticking with the charts. Just kidding. It's a joke. People do it, but I don't do it. Basically, their time frame is less than 1 hour. The tools they use is 1 minute charts. They use level 2 in time and sales. Now let me explain to you real quick what that is, because if you want to get into day trading, you need to know that. Though it might not be as useful these days. So when you're day trading, right, you're not looking at something like this. You are. When you're day trading, it'll look more like something with level 2 and time and sales. So basically, it's not showing right now because it's not live, unless we can get some live market. Well, this is Bitcoin ETF, but can't trade. So time and sales would be over here, and then level 2 would be right here. Let me show you what it would really look like. Level 2 time and sales. So if you're a day trader, you guys see people sitting at the monitor and like, I don't know, like a floor. They have this pulled up. They have a stock pulled up. Let me find a nice looking one that I could sort of explain. This one looks kind of nice. So it looks something like this. So right here's your level 2. Level 2 is basically showing you like the real-time bid and ask. Right? It's a market. It's a deal. It's an exchange. It's negotiation. It shows you in real time. Oh, is it kind of blurry for you guys? Is it okay? Well, maybe it's just a picture. Let me know if it's too blurry. I could fix it. But basically, level 2 shows you the action, how deep the market is, right? So for example, like this. Someone wants to buy it at this price and this amount of shares. Over here, someone wants to sell it at this price with this amount of shares. So if you're day trading, you draw out the intraday support and resistance lines, right? The pressure, you start to see people accumulating at a certain point in level 2. I don't do that. I'm aware of it. I did in college. It's just, I want to go build something, not so much focus on trading all day, I guess. Building an income stream. Like I'm more of a businessman, but I like investing a lot too. Sorry, I'm like fighting with myself. Anyways, that's level 2. As for time and sales is like the legal documentary of every transaction that happens. It will show you where all the handshakes happen, and when the handshakes happen, then it has to be legally documented, because this game has to be fair. So it's not rigged, as a lot of people think. If you play penny stocks, then that thing might be rigged because it's so small. But if you're trading something like Apple, it's very hard to rig because the game is so big. So that's a little introduction to being a scalper or day trader.
I think this shows up in like crypto exchanges.
Oh yeah, you're right.
Everybody shows up.
Yeah. Let's see, Poloniex. Yeah, crypto exchange would probably show you. You would have to pay for level 2 information.
But in crypto, I think.
Well, this is an example of level 2 right here.
Right. Yeah.
Right? And it shows you the depth of the market. Oh, trade history, time and sales, pretty much. This is it right here. So when you guys are, this is what this is Poloniex. It's just where I get my Bitcoins and stuff like that. Yeah, so that's the life of a day trader, right? As a day trader or scalper, you don't really focus on financials, guys. You just focus on the intraday charts and because you're gonna get out of your position in like seconds or hours. Day trader, tools that you can use is 1 minute, 5 minute, 30 minute, 60 minute, and 4-hour charts on a day. Maybe not the 4-hour, maybe at most 60 minutes, right? If you guys don't understand what that is, let me show you an example. So right here, what I have right here is a daily 1 year, meaning all the candles in here are 1 year, and each candle is 1 day, right? If you go and look at the 1 minute, this is 1 day right here, versus 1 candle stick. This is just 1 day activity right here. So if you wanted to day trade, this is what you'd be looking at, 1 minute, 5 minute. But I just, for me, I look at the day chart, but I use that to get into my positions when I trade. So moving ahead. So that's a day trader pretty much. They trade from 6:30 a.m. to 1 p.m. Pacific time. Swing trader, that's what I am, or investor. You can mix the two for me. My tools personally is definitely technical analysis, which is the charts, right? I look at the daily, the weekly, and the monthly. I look at the bigger picture of things versus the tiny picture. So this is why you have to figure out what you want to be. I also do a lot of financial and macroeconomic analysis. Macroeconomic, just to kind of gauge if we're still going up or not. Financial analysis is really where to see if like there's a growth momentum opportunity to invest in a stock.
Are there any books to become a swing trader?
Yeah. My favorite one is the title is funny, but it's by Investors Business Daily. It's very good because they have a outperforming model. It's how to invest in stocks. I know the title is like, but let me see. I forgot the name of the book.
I think it's how to make money in stock.
I think it's How to Trade Stocks. The name itself is very like, it hits average Joe really well. Average Joe will be like, oh, I'm gonna pick that one. But like a professional or like an intermediate advanced person, they'd be like, another title like that. How to Make Money in Stocks. So they have a series, but I think a very great beginner book if you want to start out.
That's the one?
Mm-hmm. There's a few different ones, but you pick the I think it's the orange one. They should give me a referral fee for this. Just kidding. This one right here. This is the one that would complement today's activity if you were to take investing seriously. Okay. Anyways, going on a little bit more. So that's what I do, and I also listen to earnings reports. Right? I listen to, I analyze at the quarterly, semi-annual, and annual. Right? It's just it will be repetitive for you guys. Because it's like, how do you really develop a skill? You have to practice. Bruce Lee didn't get to where he was without throwing kicks, right? You got to throw kicks. So, I just analyze for fun. I got a question for you guys, actually. I was talking to my buddy this morning at 7 a.m. I called him. I'm like, dude, like, what do people do on weekends? Because I'm here preparing for the meetup, and I'm just like, this is what I want to do. Like, I got nothing else to do in my day. After this, I'll be at a cafe doing the same thing. So I'm curious to know, like, what are you guys doing these days? Anything interesting? Nothing?
Real estate.
You what?
I look at real estate.
Oh, you look at real estate? Like real estate deals, or what do you do?
No,
Open homes?
yeah, my initial background was in real estate. So, whatever house like you buy,
Yeah.
you rent out, you
Yeah.
get 4 to 6%.
Oh, so are you like a property manager, or?
No, I buy properties, I rent them out.
Oh, that's awesome, man. Yeah. Hey, well, interesting to know. Well, yeah, I mean, I'm just like trying to see like what people do for fun on weekends, besides like what everyone else is doing. Anyways, working down the list. Okay, if you're an investor, time frame, 1 year plus. All right, tools would be definitely heavy emphasis on fundamental analysis and qualitative analysis, which is what we'll look at next. Chart analysis would be light, and you're going to be looking long-term. JC likes to look at the weekly chart, and I'm starting to see that as a good model too. So for investors who want to be investors and just kind of want to sit back, a good model to play is like a weekly chart combined with a 10 and 20 and 50-day moving average. That seems to be a powerful combination from like a simple back test of the eye, right? Let's pull this up. So let's do weekly, maximum weekly. And this is SPY, but let's do something like, anyone got a stock they want me to look at? Tesla, TSLA. So the strategy of this will be get in position when we get a crossover of the 20 over the yellow, the 50, the 20 over the 50, right? But it has to be a breakout. So for example, if we were to do it here, we would not get into position until either this breakout, or this breakout, or this breakout, right? And then we would stay in position until a break of the 20 MA or the break of a crossover break. That's a simple model to trade for Tesla, right? It would have done massively well right over here. Again, we got the weekly and just two simple moving averages. If you keep it simple, you can play that way. Let's do a stock that everyone knows, like Facebook. This one would definitely probably respect that. So if you were to play this model, right, you probably won't get it here perfectly, right? And then the model is already in play right here, as you can see. And it's still in play. If you were to say crossover, get out, as of today, it'd still be in play. But you would have to, let's say your time frame, you started in 2013, you saw Facebook, you wanted to buy it, but the model is already in play. So you wanted to play the model, and what you could do is just take a position on the next breakout. So it'll be right there. Breakout right there, and you kind of confirm that with some volume. Right?
Where did it break out?
It broke out above this area into new highs. Right? Because breaking into new highs is a bullish indication. Yeah. Yeah, so that's a model for that. I think that's a great investor model. You guys should, I don't know, well, if you want to consider it, right? So that's pretty much it for being an investor, if that's something you're looking into. So let's look into, what do I consider when I look at stocks? Definitely the financial statements. We look at the profitability and the health of the company, right? Through the income statement. The income measures profitability. The balance sheet measures net value, right? Let me show you what it would look like. If you guys were to use FinViz, you would go to statements and you get your financial statements. And then it'll be broken down to income statement, balance sheet, and cash flow statement. All right, that's sort of the boring part for everyone. But I mean, how do you make money in the market like this? Or without putting in due diligence? You gotta put in the work. That's just how economics works. Where was I going with that? Now, there's also ratios. Now, you guys will pull up a lot of stocks, whether it be on like Reuters or Bloomberg or whatever, right? You're always gonna get a standardized set of ratios. And this is what the ratios look like right here. Anything from PEs to PS to PBs, EPS and all that. This is really helpful to get a quick snapshot understanding of the financial statements. That's why I constantly look at it, right? On top of like looking at is EPS growing. EPS is really income divided by shares, right? Earnings per share. If we multiply this 0.47 by shares, then it should equal this. I'm trying to eye to see if that's true. It should be. But it's heavy on the eyes for a beginner, I'll tell you that. Like, is it okay for you guys? Like, how do you feel when you sort of look at this right now? You kind of...
Aside from what you've told us about the gross operating profit margin,
Yeah.
that's all I know.
Oh, that's all you know? Okay. Yeah. So basically, everything is a multiple on here. It's a multiple of something. So if we could go over each one real quick. I won't go over, I mean, there's some that I don't really use, so I don't really know it. But right here we have the, on top we have the index, tells you what index they're traded on. Market cap's important, tells you how big the company is. And then the income is telling you, like, what is your net? How much money do you really make? right? Like you can make 100K a year as an employee, but after 50K in expenses, you make net income of 50K. So that's their net net. And we want to see that net net grow because net net is EPS. If you take net net divide by shares, you get EPS, right? And then sales is, sales is sales. Like everything that like if you manufacture a car, you sell a car for 20K, but it costs you 5K to make. So your sale is 20K, but your income is 15K. That's the difference. Book per share. Book per share is basically net equity divided by shares. This is a little complex, but it's a balance sheet multiple. It's showing you if you were to take all the assets and all the liabilities, you'll get a net, either net asset or net liability. So for this case, it's positive, so you get a net asset. You take that net asset, which is your net worth, divided by how many shares you issued out there. That's your book to share ratio. This one looks at cash to share. Cash to share is basically in your income statement, in your balance sheet. You have to understand there's an income statement and a balance sheet. Income statement is your income, your salary. Your balance sheet is all your assets. So within the balance sheet, there's an account that's like called cash. I think it's better if I show you guys, right? So we look at the income statement and then the balance sheet. That multiple is a multiple of, which one was I looking at? Cash to shares, right? We're taking all the shares, and right now we're looking at the income statement or balance sheet. We're taking, look, this area right here is the liquid area part. It's the cash part. So we're adding all the short-term cash and dividing it by shares. So then we get a multiple of like how liquid they are, right? Relatively liquid. Now, you don't really have to look at that from my experience, but you can, right? If you really want to geek out to finance. Over here is dividend payment, dividend percentage. Employees, is it optional? Yes. Is it shortable? Yes, you can short the security. Recommendation, I don't look at that. But as you can see from that guide right there, 1 equals a buy, 5 equals a sell. So it's leaning more towards a buy. But I don't look at that. But Salesforce is a good stock. PE multiples I look at. PE tells me it's a multiple of your income, your salary. So if you make 100K and you're a stock as an individual, and I want to buy you out, but you cost 2 million, then, or you make 2 million. Wait, no, I'm sorry. You make 100K, I'm trying to buy you out at 2 million, then your multiple is 20. That makes sense? Like you make 100K and I'm going to buy you, you're worth 2 million. So you're at a multiple of 20 on your income. You see what I mean? So we do that. We look at a lot of stocks to see how far are they trading above their actual earning. So I look at PE. And you could also look at price to sales. For PE is just like a forecast. You would have to look at the formula specifically to see how they do it. Price to earnings to growth. This factors in the growth on top of the PE. So it's like P over E divided by growth. How they calculate the growth, I mean, I don't really look at this, so not something I factor in my trading or investing. Price to sales I look at. Sales is just like the net sales, not net income. Right? So I just want to see the multiple of the sales. Over here is, again, a multiple of the book value. Funny, because it's almost like books to shares, but this is price to balance sheet. So let's say your net balance sheet is whatever it is, right? For Salesforce, they have a net balance sheet, all your assets, all your liabilities, your total, let's say 9 billion, right? 9 billion divided by the shares, and that's how you get your net. I'm sorry, not divide by shares, divide by price. Price divided by that value, 9 billion. So price would be this, 101 billion divided by that 9 billion, and you get a multiple of about 9.32, right? So it's trading at a multiple of about 9 times all your assets. This is helpful when we look at, small businesses if we want to consider buying it, though I don't think they would look at balance sheets. They would just look at income statements for small businesses. Over here we have price to cash. Very similar to the other one. It's a multiple of the cash, of the liquid cash that they have on hand. This one's the free cash flow. It's a multiple of like an operating income. I don't want to get too boring, so I'm gonna speed up a little bit. All right, guys. Over here we get some liquidity metrics, quick and current ratio to see how liquid they are. Over here is debt ratios, a little bit of maybe 1 year and then longer term debt. And then this is like SMA 20, showing you how far it is away from the 20-day moving average. EPS in the last trailing 12 months is about average of 0.92, right? And we want to see positive. EPS estimate next year for the next quarter, EPS for this year, next year, percentage-wise, so more EPS stuff. Sales past 5 years, sales quarter over quarter, earnings per share, quarter over quarter, right? The next earnings date. Again, this is like kind of like the same right here. The SMA 20, 50, 200, how far is it away? The further it is away, the more bullish it is, right? These three right here, right? And the margins that we talked about earlier, your return on investment. I need to see the formula for this one, but return on equity would be your return on your balance sheet. And then this one would be return on your assets. So this is return on your net. And then this is return on your, I gotta look this one up. I don't look at these. Insider transaction shows you their transaction. Institutional ownership. Remember, there's insiders who own the stock and external money managers, institutions who own the stock. So it gives you an idea of that. Insider transactions, insider ownership, or own, percentage of the shares, I'm guessing. I don't look at that. I look at the float, how many shares are out there, because the shares really tell you how much the stock will move, right? The short float, how many people are shorting it? Short ratio, just a ratio of that. Target price, what the analyst has. In the last year, what was the range of the stock? Right? Is it trading at near its upper end of the range or lower end? 52-week high, 52-week low, right? The distance away from that, not too far away from the high because it's traveling higher, right? RSI is just a tool, like a relative strength index. It gives you a number, I guess. I don't look at that. I do look at relative volume sometimes in the penny stock world. But in this world, not so much, because it's like the charts speak more in this world. The average volume and then the net volume. And then the performance over the week, month, quarter, half year. This is very helpful. I look at this too. The stock's beta, average true range. I don't look at beta. Beta is sort of like a volatility measure of the stock compared to like a S&P 500. I don't really look at that, just because I focus on the charts. That's where the value really comes in. And then the previous close, where they closed last Friday, and then the price that it's at right now, and then the change of the price. Now, was that tedious? Was that okay? I hope you guys are still alive. You're pointing at him? But that's really what it takes to analyze a stock in terms of just the quick ratios.
Probably have to read the book.
Yes, but the book won't go into that. The book will be more of a short form. I'm showing you like the more deeper technical stuff if you want to be like a deep, like skilled investor. The book will show you like what's enough to make money. But you know, it's not enough to buy out a company if you want to buy out a company. But that's the gist of it, right? So I'm sorry if that took a little long, guys. I know we have about 7 minutes left. I'm gonna try and make this as valuable as possible. I won't force you guys to stay, but if you guys want me to finish it, I will. So that's financial ratios. You gotta know that. We reviewed the income statement, the balance sheet. Now, other things that I look at beyond just the financials, right? We gotta understand the business mix of the portfolio, right? How does this company derive its income? If you look at something like an Amazon, right? Amazon does not make its money just from its website. About 40%, is from, 40% is from AWS. You're familiar with AWS, I'm guessing?
I work on it.
You work on AWS? There you go. So they're also a data cloud player.
Oh.
Yeah. So that's why it's really helpful when you're looking at stocks. You have to understand that not every stock does one thing. They have multiple streams of cash flow. Very important. The business model, right? Basically the business equation. What are the inputs and it equals the output, right? You add a bunch of workers and a product equals what product? And typically I like to categorize it as either linear business or platform. Linear is like what I always use as a cafe. Very systematic in a sense where you get the beans, the worker, and the equipment, and you transform it into a cup of coffee. Platform is a little bit different. Platform is a business where you get your consumers and producers to build your business for you. some of the leading businesses right now in the world, like Apple and stuff, are platform business models. It's a next gen type of business model. Another thing I look at is the business age, right? Early on in this talk today, I talked about the next generation of enterprises versus the legacy enterprises. Be aware of, like, when you're looking at stocks out there, there are like there are legacy companies that I wouldn't work for them. Just understand the age of a business. The business efficiency is very important as well. Efficiency across income capture. How good are they at capturing their income, their sales force and all that? Their employee count. If you have too many employees, it's not really efficient in my opinion. So the higher your income, the lower your employee, that's a valuable metric that we could use in our analysis. Is the business asset heavy versus asset light? If you're a software company, you're asset light. If you're an industrial company, you're asset heavy. Right? What's the macro trend here when I think of stocks? Does this particular stock play in some kind of emerging macro trend? Example would be Intel stock and data centers or cloud play, right? Because if it's a huge macro trend, the stock has a lot of upside. That's just something you need to consider. What is the product or service development? Are they constantly introducing new products in development? Am I constantly introducing new awesome content into this meetup? Or am I recycling the same old PS? No, I'm kidding. What is the market opportunity, right? Where are they selling in? Their competition and stuff. Do you guys understand, like, when I say market opportunity? If you listen to a lot of earnings calls, they talk a lot about market opportunity. Basically meaning, like, okay, you want to start a business today. What market are you playing in? The data center market, the RAM memory market, the food industry market, right? That's the market opportunity. And then there's leadership, management, and culture, right? Maybe you guys follow an executive you really like Elon Musk. He's kind of, there's a lot of premium versus the value he offers. Right? His company's not making money, but people bet it up. Technology stack. I think this is actually a new era of analysis I would consider here. Though that's a little bit more intermediate advanced. We're basically measuring the technology stack of an enterprise, the quality of it. Like, if you're using Excel sheets versus there's automated software, application software for what you're doing, then you're not being efficient. The beauty of that is that in Excel sheet, you can only do like a 1 to 50 relationship or 1 to 50, one worker to 50 load, versus like application software could help you do 1 to 1,000. So if you have a 1 to 1,000 efficiency, I want that stock. That's the logic behind it. So I think technology stack would be a new era of analysis that a lot of analysts are not looking at. Competitive edge and market leadership, right? Where does it stand in the market? Who are their competitors? That's something you need to think about when you want to do deep analysis of a stock. Operations. I'm skipping ahead a little bit, all right? Operations, marketing operations, sales operations, admin, strategic operations. These are things to think about as well. Internal versus external in transactions. Are CEOs or other executives buying? If so, at what rate? All right, what time frame and what rate? Are money managers buying? If so, at what rate and what time frame? And then the price chart, looking at charts in different time frames. And then the product and service social influence. This one's a little interesting. I consider it because, in the world of the internet, you guys hear the whole Netflix and chill. When people start talking about business like that, just Google it. When you use it in everyday language, that screams influence and power. That's a stock to consider, in my opinion. But that's pretty much it. I wanted to go into some stocks, but maybe not the time. I think you guys look kind of tired. Or if you have any questions, I don't want to hold you over 2 hours, right? The next thing I had was just really the exercise, analyzing. What do you guys think? How do you guys feel? Do you feel like you have the energy for more? I know it's been 2 hours. Or you guys want to just say, hey, this is good enough? Any comments? Should we go on or should we call it a day? What do you think, JC?
I'm okay.
You okay?
It's up to you.
Okay. Yeah, well, at the 2 hour mark, guys, I don't force anyone to stay. If you guys feel like you had enough, feel free to check out. That's something I always like to notify when time comes. But let's look at some stocks, guys. So this week was not bad. I like this week. We do have a stock simulator. I haven't been paying much attention to it. I guess I'm getting more busy. I'm trying to build an income stream for myself because I'm really just trying to smooth out my equity curve. Let me explain what I mean by smoothing out an equity curve, right? For example, let's say if you're a 9-to-5er, right, your equity curve is probably like this, because they like to pay you slowly, right? And let's just say you make 100K. 100K. And now, you know, you want to get to the next level, so you want to, I don't know, boost this by working a side job. Side job, you get a little bit more, right? 120, let's say. For me right now, I'm making a certain amount of money and I'm investing, so my chart personally would probably look something like this. Sometimes I get a big win, no, I'm just kidding, and then a big lose, but something like that. So my attempt is to, you got to build a business that, a business is really a recurring model that people come back to you for a service, right? So I could smooth out my equity curve so that it'll look something like this. It'll be higher, but it'll still be choppy because I like choppy. I like taking some risk. I just thought this simple model would kind of help you guys kind of determine what you want to make, right? So for example, let's say if you're a home flipper, oops, I'm trying to save it. You mentioned that you're a home flipper, your equity curve would probably look something like, let's see, something like, let's do a different color. Oh, well, not red. You'd probably be like this, right? No money, and then, right? That's another way of living, right? Or if you're waiting for that big commission, a business broker I know, he made 250 grand recently on a deal. He was literally like this. Something like that. So you figure out your equity curve, right? I'm trying to make my equity curve a lot smoother on top of the trading. So this is a simulator for you guys, for you new guys. We just created for fun. It's about a year back, probably a little bit over a year now, a year and a month or something. But this is kind of how we trade, or how I trade. I haven't been managing it proactively, just because I'm kind of lazy with this one. I focus more on the real money. But we do have some shorts, some options, and some long positions. Just a little update. I haven't broke that 1 million yet. I'm still trying. We started with 1 million. So just, you can do the math on that. Looking at some stocks. Do you guys have any stocks you want me to look at? People online, people offline?
Autodesk.
Say again?
Autodesk.
Oh, Autodesk. ADSK, right?
Yeah.
I like that one. I like this one. So it helps to pick a stock that you like, right? Because I'm guessing you'll listen more. I like this one. You're seeing some support at the 100-day moving average. Let me know if you want me to use the black charts. But I typically get lazy these days, and this works out fine for me. So I like the support right here, especially at the 130. So I'm seeing some buying right there. And I like the fact that it's about to travel above the 20-day moving average. But so far, looking at just the technicals, not bad. I like it. You got about 80% gross margin, so they make a lot of money. It's just the sales has been declining, and EPS has been hurting pretty bad as of recent, causing the stock to maybe get some volatility in the short run. But overall, if you were to play that weekly model, the investor model, let's say I'm assuming you're a weekly investor, ADSK, you would still be in play right now if you were to play that model. The model says to remain in, right? So it looks good, but it's not profitable right now, right? Minus 500 million in income. That's not good. I mean, it's sustainable wise. Let's see if how big is their balance sheet? Their balance sheet, is it growing? That's what we want to know. Their balance sheet, oh, it's EBITDA. I'm looking at income. Right. Balance sheet. So about sideways for the balance sheet. Not growing, but not going down either. So it's trading about, oh, there's no multiple, oh, because there's no income. So there's some headwind, fundamentals wise, there's headwind. Technical charts wise, it's showing that it's holding a higher level. It might want to go up. So it could have like some sort of disruptive technology in that sense. Does that kind of answer my analysis for you? Or?
Yeah.
Okay. I mean, I like the charts. Eric wants me to look at Facebook. I'll look at Facebook in a second. So, I mean, in a perfect world, right, the chart would be like even escalated higher, we'll get like a nicer like looking EPS in the positive territory, and sales will be growing, right? But you know, every stock is always in motion, and the financial profile always changes. Yep. So Eric wanted me to look at Facebook. Let's look at Facebook. Let's do advanced daily, right? Facebook. Back in like February for the index in April, it broke down the 200-day moving average, but we finally broke back up, right? The moment it broke up, it consolidated, and it just started climbing ever since. This thing is looking bullish. I mean, not much to say, Eric. This is a prime company. EPS and sales can't look any better than that. Gross margins can't look any better than that. I mean, it's top 5 in the world for a reason. Or is it number 6? Anyways, this is a fundamentally strong company, socially influential company as well. Everyone has a mobile device. They're on Instagram, they're on WhatsApp, they're on Facebook. The cash flow is amazing, right? The technicals are screaming higher. The only thing that's probably bad is you stopping yourself from not considering it. No, okay, but that's not a recommendation. You have to be careful playing higher highs, right? But it is breaking out higher, and it looks like we could climb higher. This one, as a FANG, Facebook, Amazon, Netflix, and Google, you might want to track that as an indicator. Are the FANGs continuing to go up? Is S&P 500 continuing to go up as well? All of that is critical, right? Because everything kind of kicks back into like even real estate, right? You know, just being here at the office, I get to network with a lot of real estate agents, especially the big guys who are bringing in like almost 100 million in real estate sales. They're saying how like since June they felt the market kind of slowing down. And for us in the stock market world, since February, we've been slowing down. So it's slowing down for us here just as for them. That's a little insight that I share with you guys. So Eric, my analysis for Facebook, let me know if that was good for you. I like it. The charts are bullish again compared to where it once was back in April. The charts are bullish now. The financials are still, you know, in good condition. The only thing is, yeah, it's trading about 7 times the balance sheet, but in this market, guys, everything is overvalued, right? Stocks, bonds, and real estate, it's all expensive. You just gotta play it at that level until we get like, you know, an awesome correction that, you know, hopefully people are prepared for. But yeah, I like Facebook stock. How am I kind of playing in this market? I'm mainly focusing on enterprise application software with high gross margins, but I'm looking at things with high upside, so like mid-cap stocks. This Facebook right here is a large cap. That's why it's sort of difficult to kind of bet higher because it's intimidating, right? It's not investing, you know, if you want to make money, nothing is easy. You got to put in some type of work, some type of value. Even content generation, as I've learned, it's not easy. Allocation of resources. Oh wait, I'm reading all the way back. Icon, how to make money. Can you look at Facebook? Thank you, guys. It's clear that the stock is bullish. Yeah, I mean, it's a great example of seeing like a really bullish stock, right? It's as good as you could get, but maybe it helps to give you a contrast of a bad company, something that's doing poor. You know, if you notice, like here's a penny stock short right here. In the Investopedia account, this is pretty much how I won those market competitions. See, shorted 500 shares at 14, now it's at 18 cents. This is a repeatable model that I should, you know, kind of focus on. But this is what maybe a bad financial profile would look like. All right, EPS down, sales like that. But this is what a pump and dump would look like. Looks like Bitcoin?
No, I'm saying first.
Yeah. Yeah, we analyzed a lot today, guys. After this, I think I'm just going to go to a cafe and just, you know, do some reading or hang out. Nothing much. I guess okay, I wouldn't say this is an issue, but these days when I hang out with my friends, we still do, but we like as you get older, I guess, but the volume of hangouts has reduced, and then I notice I spend more time alone. Not alone, but like, it's more time doing my own things. Is that common with you guys too, or? No? Not going through like a middle life crisis or anything, but just, yeah. There's water over there if you want, Shati. There's water if you want. Oh, yeah, it's in the corner.
Okay, let me ask you your opinion on something.
Yeah.
We have earnings season coming up,
Yeah.
we have a whole bunch of earnings.
Uh-huh.
I'm thinking like near tops of markets, usually earnings season, when companies report earnings, everything is priced in as far as their beats. So most of them should beat earnings.
Yeah.
And the whole key is gonna be their guidance. So I'm expecting to see a lot of companies saying they beat bottom line, upper line, but the guidance is weak and then going down 4%. Or if they say, they beat the numbers and then the guidance is good, it's gonna go up 8%. So I think the key is gonna be, from my opinion, it's gonna be all guidance.
Yeah.
And most of them should beat the earnings if everything's already priced in. I was
Yeah.
wondering what you thought about it.
So the thing about earnings is that it's unpredictable. I haven't seen, I've searched like the corners of like, not the world, but like the digital world. I haven't found anyone that could really successfully predict earnings. Even like the great money managers who are fundamentalists, like Microsoft, it's a great company. It'll gap down on earnings, but I would buy it still because I like that company. It's robust. So I unfortunately I can't help with earnings. I'm turning on the water. Okay, there is filtered water, but okay. I think the energy is kind of low, right? You guys seem kind of tired. I won't force you guys. Let's call this a session. I hope you guys enjoy it. People online, it's a beautiful Sunday. Go out there, enjoy your life. Go to a cafe, read a book or two. Hope to see you guys on a mixer, and let's try to get some deals for everyone. That'd be fun. So I'm gonna clock out. All right. See you guys next week if you guys show up. Thanks for coming.
Awesome, thank you.